$500,000. That's not the price of a nice house in 2026. That's the floor. That's what a 1,000-square-foot box with a cracked driveway and popcorn ceilings costs in half the country right now. Let's set the benchmark. Median household income in America sits around $86,000 a year. So we're asking regular people, teachers, nurses, mid-level office workers, to buy a house that costs almost 6 times what they make annually. Your grandparents bought a house at 2 or 3 times their income. You're being asked to sign up for 6. Here's the ladder so you understand how bad it actually gets. On the low end, a starter home in a smaller market runs you around $350,000. That's rough but survivable for a solid income. In the average American metro, you're at $500,000, which is where most listings sit right now, whether the house deserves it or not. And at the extreme end, in cities like Denver or Austin, $500,000 doesn't even get you a house anymore. It gets you a townhouse with a shared wall and an HOA fee that increases every single year. So here's the sentence I want you to remember. You are not failing to afford a house. The math was never designed for you to afford it in the first place. Everyone around you keeps pretending this is normal. Your mortgage broker says you're approved. Your parents say they did it on less. Some guy on your phone says he bought 4 rental properties with no money down. None of them are going to show you the real numbers. So let's show you the real numbers. Let's break down exactly how a $500,000 house gets sold to you as affordable, when the actual math says the opposite. Here's how the trick works. Here's the trick. The bank doesn't calculate whether you can comfortably live your life. The bank calculates whether you'll probably still be paying them in 3 years. Those are 2 completely different math problems, and only one of them is being solved for you. Let's do the real math. 20% down on a $500,000 house is $100,000 in cash. The median American savings account holds around $8,000. So most people aren't a little short, they're $92,000 short. That's not a savings problem, that's a math impossibility on a normal salary. So instead, you put down 10%, $50,000. Congratulations, you just unlocked private mortgage insurance, an extra $200 to $400 a month forever until you hit 20% equity. That's a fee you pay so the bank feels safe. It does nothing for you. Now the loan itself, $450,000 borrowed at a rate around 6.5%, puts your principal and interest payment at roughly $2,800 a month. That's before property taxes, which run another $500 a month depending on your state. Before homeowners insurance, another $300, higher if you're anywhere near a flood zone or a wildfire zone, which is more of the country every year. Before maintenance budgeted at 1% of home value annually, so another $417 a month, whether you spend it or not, because eventually the water heater doesn't ask permission before it dies. Add it up, $2,800 plus $500 plus $300 plus $417 plus the PMI. You're at roughly $4,400 a month. Not for a mansion, for a starter home. Now the twist. Financial advisors say housing should eat no more than 28% of your gross income. Run that backward and you need to be earning around $190,000 a year to hit that number comfortably. Here's the stat that makes it worse. Only about 15% of American households earn that much, which means for 85% of the country, this house was never affordable. It was just approved. Meet Dana, 34 years old, works as a marketing manager, makes $78,000 a year. Her husband, Marcus, is an electrician, brings in $62,000. Combined household income, $140,000. On paper, that sounds solid. That sounds like the kind of household that should own a home without blinking. After taxes, after his union dues, after her 401k contribution, they're bringing home around $8,600 a month. Subtract the $4,400 housing cost we just calculated, they have $4,200 left for everything else in their entire lives. 2 car payments because Marcus needs the truck for job sites and Dana needs a car for client meetings, $700 a month. Car insurance for both, $250. Gas because nothing near their new house is walkable, $300. Dana's student loan from her marketing degree, the one that got her the job that qualifies her for this mortgage, $450 a month. Health insurance premiums their jobs don't fully cover, $350. Groceries for 2 adults trying to eat something other than instant noodles, $700. Daycare for their 4-year-old because they both work full-time, $1,200 a month, which by itself is nearly a third of what's left. Added up, they have roughly $300 left over. Not for savings, not for retirement beyond the minimum. $300 for the entire unpredictable mess of being alive. 1 car repair and it's gone. Now, here's what you're probably thinking. But I make more than that, or I don't have kids, or my rate is better than 6.5. Fair. But the data says most of those exceptions don't move the needle as much as people think. Even households earning $20,000 more than Dana and Marcus are typically 1 job loss or 1 medical bill away from the same $300 cliff. Because the expensive part isn't avocado toast or takeout coffee, it's the $4,400 number sitting at the top of the page, eating everything before it even gets to your discretionary spending. Dana and Marcus aren't irresponsible. They didn't buy something crazy. They bought exactly what the market told them was normal. That's the part nobody wants to say out loud. The house isn't the reward for good financial decisions anymore. It's the trap door underneath them. Here's the boring alternative nobody wants to hear because it doesn't feel like winning. Instead of that $500,000 house, Dana and Marcus rent a similar 3-bedroom for $2,200 a month. Not glamorous, not an asset, just a place to live while the math sorts itself out. The difference between renting and owning, once you include the mortgage, taxes, insurance, maintenance, and PMI, is roughly $2,200 a month. That's $26,400 a year they're not spending. Now run that number forward. If they take that $26,400 difference and invest it every year in a plain, unremarkable index fund, averaging 7% annual returns, here's what happens. Over 20 years. Not $50,000, not $200,000, just over $1.1 million. 1 decision, quietly compounding in the background while their friends post pictures of a kitchen renovation. Let's be honest about who actually profits when you stretch for the expensive house instead. The bank profits, 30 years of interest payments. The insurance company profits, a policy you're required to carry. The realtor profits, a commission on the sale price whether or not you can comfortably afford it. The contractor profits when that water heater finally gives out. Everyone in that chain gets paid the moment you sign. Nobody in that chain gets paid if you wait. So here's your actual next step. Tonight, not next week, sit down and calculate your real number. Take your take-home pay, subtract every fixed expense you already have, and see what's actually left for housing before you look at a single listing. Compare that number to what the mortgage broker says you're approved for. Notice the gap. That gap is the whole story. Now, the honest exception. If you make well over that $190,000 threshold, if your job is stable, if you have no debt, and a real emergency fund, this math doesn't apply to you the same way, and you're allowed to buy. This isn't a rule against homeownership. It's a rule against pretending a bank's approval letter is the same thing as your own financial safety. Because here's the thing nobody in real estate will ever tell you. Waiting isn't losing. Renting a place you can actually afford while your money quietly grows somewhere else isn't falling behind. It's the rarest, most disciplined move left in a system built entirely to get you to sign before you've done the math. Anyone can get approved. Almost nobody has the patience to say, not yet.